Welcome to the Sexy Freedom Media Podcast, a place to discuss pain, passion, and pursuits.
Let's get it. I want to feel alive.
Breathe.
Make some moves.
Protect the throne. This is Sexy Freedom Media Podcast.
Welcome, everybody, to the Sexy Freedom Media Podcast. I'm your host, Helen Edwards, financial strategist, author of the book, Nothing Sexier Than Freedom, and here to help you all get inspired and empowered. And I'm here with my co-host,
January Liddell. I'm also a financial strategist, retirement specialist. You can find me at januaryliddell.com. What I'd like to do is eliminate risk, fees, and taxes. And that's what I do.
Awesome.
Aloha.
We have an amazing show today. We're going to actually go over and discuss a book that we're both reading called The Power of Zero by David McKnight.
Awesome. It's a very technical book, which I like, and so it is very challenging. So we are going to take this in chunks. Okay, so we're going to snack size this a little bit, and just so we can internalize this a lot better.
Well, January, what made you decide to read this book? Because I actually heard about this from you.
Yes. Well, David McKnight wrote How to LIRP, or Before You LIRP. And I love that book, Before You LIRP, because it talks about how to get into the tax-free environment side. Now, the reason I wanted to read The Power of Zero is because who doesn't want to be in the 0% tax income bracket? And that's me. I want to be in the 0% tax income bracket. So I'm a little bit selfish because I'm thinking about myself and I'm thinking, hey, what do I want for my own retirement? But in the art of doing it for myself, this is also helping me share with others. I'm very big on, if I'm not doing it myself, then how am I supposed to share it with you? Which is why I'm reading this book, The Power of Zero, how to get to the 0% tax bracket and transform your retirement. So let me just share a little bit. Okay, so I'm going to share the first page. A gathering storm. On January 11, 2011, a CPA named David M. Walker appeared on national radio and made a grim prognostication. Based on the current fiscal path, future tax rates will have to double or our country could go bankrupt. He then challenged the national listening audience to come up with a 4-letter word that would explain why. So he asked the question to the audience, what would that 4-letter word be? Somebody said debt. Another person said wars. Somebody else said kids. A few more said more ideas. However, David Walker finally revealed the answer. It's math. So this book is a very complicated book, but we're going to break it down in layman's term for you all, so it's easier for you guys to understand. Who is David M. Walker? He is a Comptroller General of the United States as the head of the Government Accountability Office. In short, he's the CPA of the USA. So this person actually sounded out the bell and said, hey, we're not in a good financial position. And at the time that this book was written, it was said that we were at 21 trillion. I don't think that's the number at this very moment. So, Helen, what did you get from the first chapter?
Well, I wrote down a ton of notes, and thank you for reading that part of the book, because it kind of sets the backstory of, what this whole book is proceeding to tell us. For me, I was kind of blown away because how do you get the average American to really tune into this? Because most people don't really care until it's time to care, which they think is later on in life. And there was a lot of math. It was a little bit confusing, but from what I got from the first chapter was a few notes that I'll read here. So one of them was Social Security was never intended to be a retirement program. It was merely insurance against living too long.
Let's see, 1935, the ratio for the Social Security, it was 42 people contributing to Social Security for every one person. So that's 42 to 1. But now it's down to 2 to 1. So when people depend on Social Security, this is what I got from that chapter. When people depend on Social Security, that, like Helen was saying, that Social Security wasn't meant for retirement. It was actually created for the US, for the government actually to use. So they're utilizing our money, right? And so as the years progress, because we're going into trillions of dollars, and I'm going to actually find that number for us, in debt, Social Security, and I believe there's an article I posted on my page, VIP Finance Builders, by, I think it was 2035, they will only be giving out 75% of our Social Security. That is the truth. Like, that is something that you can find online at this very moment. You can look at my page, VIP Finance Builders, and find that article. But that is set. So that's in chapter 1. I think what I got from that is that David Walker is a very prominent person to really check out. Like, you really should listen to him. And especially if he has been the CPA of the United States, he knows the ins and outs of what's been going on in the government. So for me, it was a very eye-opening chapter to show that I really should not be depending on my Social Security for my retirement, like solely on my retirement.
That was exactly what I was going to just say. I may not have understood it all, but I'm so glad I'm in this industry now, because it really pressed the point that exactly what you just said, don't rely on Social Security. And actually, it mentioned Medicare as well. Don't rely on Medicare also. The world's changing, times are changing, and there's opportunities, as we'll go further along with this book, to make more money and then put it in a safe account that you can get your money back plus interest, tax-free.
Yes, and before we move on to the next chapter, I do want to talk about the last portion of what he said. David McKnight said, "Why is the 0% tax bracket so powerful? Because of the same 4-letter word, math. If you're in the 0% tax bracket and tax rates double, 2 times 0 is still 0. By implementing these concepts before tax rates rise, you can effectively remove yourself from the train tracks and protect your hard-earned retirement savings from the gathering storm that's looming on our country's horizon." That was chapter 1. Let's go to chapter.
I like what he said. Just to wrap that up, is those who don't study history are bound to repeat it. And that was pretty eye-awakening for me, because I love history, but I never look at the financial history. Most of the time we're taught to look at the history of, our world, the house market, other things, but never the financial market. And this is really important. So I was like, okay, I want to be one of the smart ones. I want everybody I talk to, my family, my friends, my clients, to be one of the smart ones. So yeah, let's move on to chapter 2.
I love that, Helen. This is why we do what we do. We get on the podcast because there's all this knowledge that we're gaining, especially the financial literacy portion, because I feel that majority of us are not financially literate. We actually just give it, we give like our trust and whatever to HR and to whoever, like the banks, everybody, we just give our trust to them without truly fully understanding the functionality of how that works, how investing works, how the banks work. So chapter 2, the taxable bucket.
Just to set the premise here, so chapter 2, 3, and 4, in ongoing chapters. So we're going to get into the 3 tax buckets, the 3 different types. So chapter 2 is going to explain the first one.
Chapter 2 is the taxable bucket. Taxable, so the 3 taxable buckets, like she said, are taxable, tax-deferred, and tax-free. So the taxable bucket is an ideal balance. So what that means is, let's say a couple needs $4,000 per month to keep the family afloat. To determine the ideal balance in their taxable bucket, we simply take this amount and multiply it by 6 months. So the most they would want to maintain in this bucket at any given time is about 24,000. So that means that you have to calculate your outgoing expenses and make sure that you have like 6 months worth of savings in that taxable bucket. The ideal amount is whatever your outgoing is times 6 months, and that's how much you should keep. If you have more than that, then you'll be taxed more. If you have less than that, it's also not in good working order. So you have to have like kind of an ideal balance between the two.
What I really got from it was wanting to know what the taxable buckets were. So included in the taxable buckets are everyday investments like money markets, CDs, stocks, bonds, and mutual funds. So how do you know if you are in one of these investments? Well, the tip-off is you receive a 1099 at the end of the year. A 1099 is a tax bill. It tells the IRS how much taxable income you earn from a given investment.
Yes, that's right. So a taxable bucket would, include your gains, right, in the stock market. It would include your gains in the 401k, in your IRA. Those are all taxable. What else is taxable? Your income is taxable. Okay, so what else is taxable?
I think
there's a graph. Okay, so go ahead.
When I think about this, I try not to get too technical because most people are not in the financial industry. I try to just educate them like, okay, I'm going to go back to square one where I know nothing. And, people want to know, okay, where do I put my money? Where do I put my money to help it grow? Well, like we're explaining, there's 3 taxable buckets. And this first one we're talking about is the taxable bucket. And that means your money will be taxed.
Yeah, that's basically it. To cut it into simple layman's term, your taxable bucket is anything that you are gaining money, right? So if you have money in your savings account, in your CDs, in your money markets, 401ks, IRAs, all of that, everything that you gain, if you gain money in there, then like Helen said, you would get a 1099, and that is the taxable bucket.
Which, so why have any of these investments? Because they are used for liquidity. So it's easy to get your hands on for emergencies. So a good rule of thumb is to only have 6 months of savings for emergency in these funds, because the higher the amount, the more you are taxed. So be careful not to have too much or all your saved money in these taxable investments.
Yeah, that's pretty much it. I mean, at the end of the day, I guess the question is, how much money would you like to be taxed? And so if you have majority of your funds in a taxable bucket, you are not in the 0% tax bracket. You're not in that tax rate. So I would ask myself, what tax rate would you like to be, 0% or 22%? And what that means is, if I was taxed on, let's just say 40,000. Well, 40,000 times 0 is 0. I wouldn't be taxed on that. However, if I was taxed on 40,000 times 10, I would owe $4,000, right? So it's just a matter of how much money would you like to spend? How much money would you like to pay for your taxes? So that's the taxable bucket. Can we move on to the next chapter?
Mm-hmm.
All right. The next chapter is chapter 3 on the tax-deferred bucket. Okay, so the tax-deferred bucket, what these include, let's see. Contributions are tax deductible. Generally, when you put money into this bucket, you get a tax deduction. For example, if you make 100,000 this year and you put 100,000 into your 401k, your new taxable income is 90,000, hence the tax deferred, right? So you're deferring 10,000 of your dollars for later. The other one that are tax deferred. Okay, so let me say the tax deferred accounts: 403Bs, 457 simples, SEPs, KIOs, and of course 401ks and IRAs. Those are tax deferred. meaning that you're not going to pay it now, but you'll pay it much later. What are your thoughts on tax deferred?
Yeah, so for me, I'm like, every time I read a word that I never knew what it was, I was like, oh my God, what is that? So you're right, 401ks, individual retirement accounts, which are IRAs, 403bs, 457, the simple IRAs, which are savings incentive match plan for employees, or the SEP IRAs, which are simplified employee pensions, or the KEO plans. So two things in common with these accounts. One, contributions are tax deductible. Two, distributions are treated as ordinary income. So for me, 401k is the one that sticks out the most, because most people have learned, especially from like Dave Ramsey or other financial gurus out there, that 401ks is like free money. Why wouldn't you put your money in these accounts? They're free money and they match you. So I was like, yeah, that's what I was taught. That's the best option, free money. However, in the long run, it's not free because you're going to get taxed on it, like big time.
Yeah, that's right. So, and we all know, and I think I've mentioned this in another podcast, is that the 401k was not designed to be a retirement plan. So it was actually initially designed to help executives have some kind of a tax shelter or tax deduction. So it was really to benefit executives. And then Ted Benna, who's the godfather of 401k, designed it and worded it to include quotas. And quotas were cash on demand or something, cash or assets, something on demand. And it included the regular working employees. So that's how the 401k was established, was because of Ted Benna. Prior to that, it was 401 for the executives. Now it's 401k. So those are all, that is an internal revenue code. And so even the 401k wasn't even designed for retirement purposes, right? At this moment, the way that it is marketed is that this is a good savings plan, which is a good, and I'm going to say kudos to you if you are putting money in your 401k, because you are at least establishing a savings habit to save for your retirement. But now you know that this plan, although it sounds amazing, and even if you had $1 million in your 401k, you technically do not have $1 million in your 401k because you haven't accounted for, number one, taxes, number two, possible penalties if you need to take out money from now up until 59 and a half. You need, access to that money, then you're going to have to pay the penalty and the taxes as well. The other things that are included are the fees for our 401k. So that's all the tax deferred as far as the 401k and an IRA, all those. Now,
there are consequences
go
in
ahead.
having too much money in tax deferred accounts. So it's hard to know how much money you will retire with if you don't know what the interest you'll be taxed on. So that's something just to remember.
One of the other things that to remember is that as of right now, currently, if you have a mortgage, if you have children, if you are contributing to your 401k, there's certain aspects that help you, I guess, lower your tax rate, right? Your taxable income. So like the mortgage interest, every year you can deduct interest on up to $750,000 of debt on your residence. But here's the problem. Most of the retirees actually have paid off their homes. So by the time, you are going to distribute, okay, or withdraw, okay, so, but it's called, technically the word is distribute. Once you start distributing that money from your 401k or your IRA, you may or may not have a mortgage interest. And if you don't have that, then you're not able to deduct that from your taxable income. Yeah. So the next one is children. At this point, if you have young children, then you have like a $2,000 credit, right? So that also helps with your taxable income. So it lowers it. So at this moment, your tax bracket may be in a lower bracket due to just those two things, mortgage interest and your children. The next one is retirement plan contributions. Yeah, so that the retirement plan contribution, that's basically your, like, you're deferring all that for another moment. So it's also lessening your taxable at this very moment, but however, it's lessening it so that you're going to pay it later when your tax rate may be higher. And then of course charity helps you deduct, from your taxable income as well.
I feel like with this bucket, what the image that comes in my mind is like an IOU, like, oh, I'll pay you later. And you're working your whole entire life and you're working so hard and you're like, oh, this is such a great deal. I'm getting this match and I'm just working my ass off, and I'm not spending time with my kids or my loved ones. I'm barely taking 1 week vacation once a year, and at the end of the day, at the end of, when it all rolls down to that pinpoint of retirement, it's like, oh, let me just pretty much pay you all the money you just gave me for free back. And learning about this, I just think of all the people now who are retired, and most of them are going to fall into one of these three buckets, and usually it's the top two. They're paying taxes, they're going to owe money, they don't have any deductions, or they're going to have to do the tax deferred, and they're going to think they're getting all this money for retirement, and yet they're going to get taxed heavily. And again, they're going to find themselves with the least amount of deductions. And it makes me really sad for the elderly now. And that's why it's so important that we empower people, because we're the next coming to that retirement stage in our life. And it's like, okay, we can do this. We can, if we band together and we empower ourselves with financial literacy, we can figure this out. So I'm excited to talk about the next bucket.
Well, so there's a catch-22 with this bucket, right? And I love that you said that it's it's like a IOU. You're right, it's like a credit card basically, and we all know how credit cards go. The more that you put in there, it's compounded in there, right? It's compounded. If you don't pay it off at the right time, right at the next month, then it's compoundedly growing. So it follows the rule of 72. Okay, the rule of 72 states the amount of money the amount of time, sorry, the amount of time your money will double based on the interest rates. So that is the rule of 72, and that applies to not only growth, but it applies to credit cards. So in credit cards, if your interest rate is like 22%, then your amount in there, that your debt that's in there, is going to double, multiply very quickly because it's 22%. Okay, so yeah, so the tax deferred bucket reminds me of a credit card, because yes, you're going to be growing all this amazing money, but at the end of it, during your non-working years, you're going to have to pay for it. And are you willing to pay for that? Are you willing to be at that tax income bracket where, one, you're not working anymore, you're not probably going to be able to deduct your mortgage interest, or two, you don't have children to take out that credit. What was the other one? And three, you may still be doing charities. You may still be like, sharing your money with charities and donating. However, are you able to donate much more now rather than later? Which one do you feel would you think that you'd be donating more? In other words, I see a lot of retirees and they're on a strict budget, especially because inflation has increased. Oh, I didn't even account for inflation. So inflation is going to, I'm sure, double, by the time we're in our, 10 years, 15, 20 years from now. Just that last year, it increased by 8%. That's huge. So who knows what's going to happen? So the tax deferred bucket is a bucket that I do not want to be in personally. Sam, I have taken Sam out of that bucket. We are not in that bucket any longer. We do have some funds just sitting there, so I know eventually we're gonna have to pay taxes for that. But I am, like this book, trying to get us more into the 0% tax income bracket, which is what we're gonna talk about. So Helen.
Okay, so going into chapter 4, it talks about, it's the segue into the tax-free bucket. So the tax-free bucket is also called preferred, tax exempt, or tax advantage. But he says, David McKnight, the author, states that there's really only 2 ways to really know if they qualify to be a true tax-free account. So the first one, it has to meet the true definition of tax-free, free from all taxes, federal, state, and capital gains tax. And the second is money distributed from a truly tax-free investment cannot count as provisional income. In other words, true tax-free investments do not contribute to the thresholds that determine whether your Social Security benefits get taxed.
That was actually eye-opening for me too, because I didn't realize that if we were contributing more into like our investments, that our Social Security can be heavily taxed. And I don't know where that line is in the book, but it is in the book where it states that, oh, right here, interest on these bonds does count as provisional income and may cause a portion of your Social Security to be taxed. So investment vehicle widely touted as tax-free doesn't even satisfy the 2 litmus tests required of a truly tax-free investment. So that talks about, municipal bonds. So municipal bonds was one of the areas to, for a tax-free environment was a municipal bond. However, so we've been told municipal bonds are tax-free, but do they really meet the definition of a true tax-free environment? So it is true that municipal bonds is free from federal tax, but it's not always free from state tax. To avoid state tax, you have to buy a bond issued by the municipality in which you live. All right, so the next one is the Roth IRA. The Roth IRA, while that is tax-free growth and tax-free access, it's very limited to how much you can put in a Roth account. So for 50 and below, the most you could put in is 6,500. For 50 and above, 51 and above, the most you could put in is 7,500. And there are clients out there who make more than that. So obviously, having a Roth IRA is not a viable account for them because they do make much more money, so they don't qualify for it. So that's the issue with a Roth IRA.
So basically, because there's, the Roth IRA, and it is optional to possibly be a tax-free account, to make sure you may need an extra tool. And the extra tool is going back to what January said in the beginning, the LIRP, LIRP. So the LIRP stands for Life Insurance Retirement Plan, an accumulation tool.
Yeah, that's really where the tax-free environment stands, is in a LIRP. But before we go there, I do want to talk a little bit more about the Roth IRA, because the LIRP simulates a Roth IRA. So it's actually a deluxe version of the Roth. So if you're listening out there and you have much more to put in to a tax-free environment, other than 6,500 or 7,500, if you have more than that, highly suggest that you talk to Helen and I, and let's just have that conversation. Obviously, it's a free conversation for us to chat. Just a little bit more about the Roth IRA. There are restrictions. Okay, so if you have the account for as far as liquidity, if you have the account for more than 5 years, you're able to access it, or at 59 and a half. So that's the time that you're able to access your Roth. Your Roth is also tied to the stock market. So that's the only other con, I guess, about being in a Roth, is that it is tied to the stock. So you're still subject to losing money. All right. So
yeah, and it's important to know that the Roth IRA, they're designed to benefit Main Street Americans who are still earning a paycheck.
Yeah, that is true. So when you're retired, obviously, if you have money that's coming in, there's so many different like strategies you can do. But we're talking about like the tax-free bucket, and as the tax-free bucket is concerned, yes, the Roth IRA is a great place to start. But if you want to contribute more, then there's another strategy for us to do that. Okay, so that's using the LIRP. All right, so there's more to talk about David McKnight. It does get very technical and it is very challenging to read, but this is definitely a book. If you are paying taxes at this very moment, you're a working person, highly suggest that you read this book, at least so you can get some knowledge and just awareness of what to expect for when you do retire.
And I want to add that this was kind of mind-blowing for me, learning about the LIRP, because, the history of the LIRP and, who's all utilizing the LIRP. So 85% of CEOs from Fortune 500 companies utilize the LIRP as one of their primary retirement tools. Just that alone, that knowledge alone tells me, the rich know how to keep their money, and protect their money and protect their legacy. And as somebody who has a millionaire mindset, I follow and want to learn what the rich are doing. So like January said, this is a conversation we can have with you. And even if you're somebody who was like me before, where you're like, I have no idea what they're talking about, I do not get this. Like, what is the point of, trying to not pay taxes? Like, everybody has to pay taxes. That was my mindset before. And I really just didn't care. I was just like, well, $400,000 is better than $600,000. I might as well get taxed. That was my mindset before. And now I'm like, no, shift your mindset. If you're into abundance and you're into manifesting prosperity, you will shift your mindset and you will start thinking on another level. And this is that level. So like January said, we do invite you to click the link in our show notes and schedule a conversation with us.
I do want to add, because if majority of our listeners are all females, and I'm sure majority of us love a sale, because I know I do. I love sales. I love saving my money. I really don't like buying things full price. So with that said, there is a sunset clause, January 1st, 2026. That is the end of the tax rate sale. What that means is, and this is why it's very urgent for us to have this conversation, because we know exactly when our tax rates are going to increase. They're going to increase January 1st, 2026. So this is an urgent matter because you have from now up until 2026 to utilize the tax rates that we have at this very moment. Sale, right? This is a sale. So utilize this time to contribute as much as you can, fund your account as much as you can, so you can pay these tax rates rather than an increased tax rates. So again, that sunset clause is January 1st, 2026. So please have that conversation with us. We'd love to talk with you ASAP. Helen, any final
words? It does feel a little bit overwhelming when you're talking about finances and all this terminology, but I just want to encourage everybody, a few years ago, I knew nothing. And now that I do know, I'm so passionate about finances and investments and growing your money, because I know what it's like to come from a place of poverty and scarcity mindset. And, even if you're somebody who has a lot of money, you can have a lot of money and still not know what to do with it, where to put it. And I think that now that I'm in this industry and now that I'm realizing what the vehicles are, I'm excited about it. We are excited about it. We're excited to empower you. So do not feel stupid. Do not feel like you're dumb in this area. If you do feel that way, we really want to encourage you to contact us and, let's have the discussion. So yeah, finally, we are going to do our shout out. So again, thank you for listening to that first half of our opinions and thoughts on The Power of Zero with author David McKnight. But we are now going to give our shout outs because we are going to wrap this up. January, do you have any shout outs?
I do. So my friends, Des and Williamson, actually. Williamson is a chef and he creates these amazing tiramisus. I know you're not here. If you're in the mainland, you're not here in Hawaii, but if you are listening from Hawaii, he makes these amazing tiramisu. To contact him, contact 808-371-7437. He sells it by a pan, and that pan, I'm going to tell you, it's actually way too much for me. But I can eat it over a couple days. So it's probably about this big, and it's tiramisu handmade by Williamson. So 808-371-7437.
Oh, I love that. Awesome. Okay, so I'm going to give 2 shout outs here. So I'd like to give my first shout out to my friend Katrina Call, who is a photographer, awesome friend. She does boudoir photography for both men and women and couples, and she's amazing. She's out of the Phoenix, Arizona area, I believe, like Mesa area. So you can find her on Facebook, Beyond the Mask Photography. The second shout out I want to give is actually from Melissa Miller, actually, and she wants to give a shout out to her son, Owen Miller, who is currently deployed on the USS Macon Island. She says, "We are so proud of all he does as a United States Marine. He is coming home soon and can't wait to hug him and hear all about his experiences. So proud." Oh, I love that one.
Awesome sauce. I can't wait for us to talk about the next portion of the Power of Zero. And hopefully this has ignited some type of a question in your mind, and that you want to actually reach out and just have that conversation with Helen or I, and we can help you process through all of this. So really looking forward to the next one, the next portion of the Power of Zero by David McKnight.
Awesome. January, where can they find you?
You can find me at januaryliddell.com or VIP Finance Builders on Facebook, January Liddell on LinkedIn. Those 2 are the heavily ones that I'm in, and you can see more of my articles in VIP Finance Builders along with January Liddell at LinkedIn. You can also find me on Instagram. Very easy and accessible to find me.
Everybody, you can find me, Helen Edwards, on Hell of a Journey and Sexy Freedom Media on Instagram. You can also get your copy of my book, Nothing Sexier Than Freedom, which is available on Amazon and Audible. And like January said, reach out to us. All the links are in the show notes. If you'd like to support this show, which I know you do, you can buy us a coffee. Again, link is in the show notes. And thank you so much, everybody, for listening. Ahia.
Aloha.
Want to hear more?
Visit us at sexyfreedommedia.com.